When opening the order panel in TradingView, we are presented with three different trade order types: a market order, a limit order, and a stop order. It is important you understand how each of these types of trades work so you can select the right option for your trade. To find the order panel, we can go down here on the bottom right and click on Order Panel. Firstly, we have a market order. A market order is the most basic order type. It's simply a trade that will enter the market immediately upon placing the order, regardless of where current price sits or how wide the current spread is. Limit orders are used when we want to enter the market at a specific price. This is my most commonly used order type and is the default one when you open the order panel. A limit order will execute if price reaches our specified limit price or better. Now, when I say a better price, I mean a price that will increase our reward to risk ratio. A better price will be represented differently depending on our order direction. For a long trade, a better price will be a lower price, and for a short trade, a better price would be a higher price. Stop orders are very similar to limit orders, where we set our entry to be at a specific price and not either side of it. We use stop orders to jump aboard momentum in the market, and we cannot place a stop order when price is already beyond our entry price. It's like a limit order, except it will not trigger as a better price, but rather price action needs to cross our entry price level. With each of these order types, we are able to select our risk for this trade only once we have set our stop loss level. This is because it uses the distance to the stop loss to calculate the suitable number of units needed to match the amount we are choosing to risk. Let's draw out this 35 bounce so we can go through the process. I'll put that to the swing and it'll be 260, 646, and we want a 1.25 to 1. I can't set this up in replay mode as it won't let me get to the order panel, so let's pretend these candles aren't here and this is a freshly seen trade that we're about to enter. When we draw our trades on the chart and we are signed into paper trading or with a broker, whether it be a demo account or a live account, and we right click on our trade, we should be presented with the option to create limit order. It comes up with create limit order because we have set our specific price for entry. If we right click and say create limit order, we can see the order panel is now filled with all the correct info. It knows it's a sell trade, it's put it as a limit order, the entry price is correct, we have our stop loss of 64.6 pips and our take profit of 80.6, the corresponding prices that those pip amounts add up to. We have our risk, which I can set to 2%, which then shows the corresponding value in dollars of our risk, and our risk and reward based on the percentage of our account. Now, we can see the margin has been automatically calculated. It tells us the leverage on the position, what each pip is valued at, what the trade value is, essentially the margin. That's the margin value. That was what I was explaining earlier. What our reward percentage and value is, and our risk percentage and value. For this sell trade, at a risk of 2%, we would need to sell 1,564 units. Now 1,564 divided by 33, our leverage, would bring us to around $47.39 New Zealand dollars, seeing as New Zealand dollar is the first currency in this one. And because my account is in US dollars, I would convert that to US dollars, which should bring us to around $32.14 US dollars, which you can see here under our trade value. Now, I'll refer to that as our margin value because it actually corresponds to the margin it would require. And I will refer to our trade value as 33 times this, so around about 1,000 US dollars in value for this trade. Now we don't need to worry about any of this because it does it all automatically once we put in our risk and check that we have enough margin to cover it. It's as easy as that. Additionally, if we have submitted a limit order or a stop order, we can set an expiry for this order to automatically cancel itself if it is not filled. This is known as time in force. These time in force options vary depending on your broker, so I will list out some of the more common ones in the description below as a reference point for you to check out. GTC, good till cancelled, and GTD, good till date, are the two I most commonly use. When you select good till date, you can scroll down and choose the actual cutoff time and date you would like for this to expire. As an example, I will set a trade that is due to expire 1 minute from now. And there is actually a bug on my system. I'm unsure if it'll come up on yours. But when I select the 13th, it'll select the 12th. So I must select the 14th, hit the blue button here, and it will select 13th. Just a weird little offset, but it helps if you know that. Once I submit this order, we can see our sell limit is ready. Now I will wait 1 minute and the order should cancel itself. We can see this order under my working orders tab, and it is due to expire, and it has now been cancelled. This is particularly useful for stop orders if you want to cancel it after a certain amount of time if you feel price is moving in the other direction. Understanding these order types should help you choose which one is going to suit your specific strategy. The vast majority of the time, I anticipate you'll be using limit orders or market orders, but there is a time and place for stop orders.